Emerging markets can bring about spectacular gains. This is Mercado Libre, which is the South American version of Amazon. And if you bought it in part of an emerging markets or frontier markets fund when it was listed on the Uruguay Stock Exchange, you could have seen a up to 20-fold increase in your money. And it would have been quite an easy bet to take because there was a lot of lobbying around getting this business listed in the US. And when that happened, that really saw the share price motor. And here's another reason to potentially look at emerging and frontier markets. Here we've got the 3-month growth of the leading sectors according to Morningstar. And we've got things like Turkey, Vietnam, frontier markets, India, and emerging Europe, excluding Russia, being amongst the top categories. So in a time when developed world markets are kind of struggling, it might be useful to also look at emerging markets as a potential area to invest in. So although emerging markets can deliver spectacular returns, in many instances they underperform. This is Fundsmith Emerging Equities Trust FEAT compared with just the ordinary Fundsmith, and you can see there's a massive and consistent underperformance. So quite a lot of the time, although you might think there's a lot of economic growth in emerging markets, this doesn't translate through into growth in company share prices on emerging market stock exchanges. So you have to be very careful when investing in emerging markets. And in this video, I'm going to show you how to potentially avoid the pitfalls and focus on the great funds that are available. This is a list of emerging market countries, and you can see there's quite a mixed bag. Some of them have a natural resource surplus, such as the Middle East and Brazil. Others have a natural resource deficit, particularly China. There's also varying degrees of government corruption and just government stability across these different countries. So you have to quite pick and choose how you're going to invest when you're approaching emerging markets. So on the left, we have the percentage shares of an emerging markets tracker. So China, number one, nearly 27%, then Taiwan at 15%. South Korea is in some trackers and not in others. It's in the MSCI, but not in the Financial Times classification. Then on the right, we have the top frontier markets, where Vietnam is the leader at 30%, then Argentina with 23%, and Argentina was actually demoted to a frontier market, which is quite interesting. And when you're investing, be careful not to accidentally omit or accidentally double up on South Korea, depending on the combination of developed market and emerging market funds that you have. Here are some forecast price to earnings ratios for various stock exchanges. So we've got the US at 22 and India is about the same, although it's not on this graph. Some emerging markets have very high PE ratios, like Thailand, possibly because it's growing off of a low earnings base. Some emerging markets are quite cheap, like Brazil, but this is quite easily explained by the natural resources there. So the oil companies, the mining companies, the banks. So it's really sectors that traditionally have very low PE ratios. So it doesn't actually mean that Brazil is a bargain. China is also fairly low price to earnings ratio, but actually this is saying that the UK is cheaper. So I don't think any individual market is fundamentally underpriced at the moment. Here is a unique investment trust. It's Ashoka India Equity, AIE is the ticker. It charges no ongoing charges fee. It only pays out a performance bonus to itself if it's able to beat the index. So it's totally unique in this respect. It's a bit crazy. It's done quite well over 5 years. It's more than doubled. It can potentially have problems with liquidity as it's not the largest investment trust, but it's certainly interesting that the fund managers and the fund staff have skin in the game and they're really joining you on the ride to try and make decent returns out of an exciting market, which India certainly is. For emerging markets, I would consider them to be a satellite holding rather than a core holding. I would look to exclude them from my global trackers and have them as a separate thing to decide whether or not I wanted to hold them. I would look at granularity of emerging markets, so factors such as dividends or large versus small cap, and I would possibly exclude China, certainly at the moment. Here are BlackRock's expected returns across the next 5 years, looking at various different asset classes. And you can see that with Chinese equities, they're really not sure whether it's going to deliver a negative return or a up to 25% annualized return. I mean, that's just a crazy range of potential expectations, which shows how volatile emerging markets can be. And here it's clearly dependent on things like what the Chinese government does and Chinese relations with the US. But if you do your research and you're poised to potentially enter, if things do start to look better, then you could make a fair bit of money by having emerging markets in your portfolio. And here is BlackRock's latest commentary on both emerging markets and China. For emerging markets, they see potential growth, they see valuations quite low, and maybe interest rates nearing their peak in emerging markets. And specifically for China, they think there might be some policy easing and there's possible upside surprises given the current low valuations amongst Chinese equities. So I'm a big fan of momentum. If I'm going to buy into something, I like the price to be currently rising. So here are the momentum scores for some emerging and frontier market exchange traded funds. They vary quite widely from Turkey having a score of 98 out of 100 down to Philippines way down at 7.3. Emerging markets as a whole are 35 because it's weighed down by China, which only has a rating of 10.6. So there's some potential countries that I could look at, but I worry that individual countries are quite narrow in focus, quite volatile. So there's some other tilts that I could look at. So there's emerging markets dividend, where I just screen based on whether a dividend's being paid or not. There's also emerging markets small cap, which tends to underweight China and it tends to avoid some of the larger companies that are kind of currently disappointing a bit. So I do think that's an interesting area to look at if you are considering emerging markets. Another fund that I like is Redwheel Next Generation Emerging Markets. So it's got charges of 1.4%, which is quite high, but it is doing a lot of research across many different geographies. 81 holdings in the fund, and you've got the breakdown on the market capitalization there. I think this is potentially a stock picker's paradise because you've just got so much to choose from in terms of different sectors, different countries, whether you want large or small cap. There's so much flexibility to try and extract value from this area. And here's the price chart for the Redwheel fund, and it's been pretty good in recent months. It is quite volatile and it was quite badly impacted by coronavirus, but I think it's quite an interesting one to look at. This is the country exposure. You probably can't read it, but it's Indonesia's about 12%, then Philippines about 10, Mexico about 7, United Arab Emirates about 7, Vietnam's quite underweight on that, about 5. Then you've got Greece, Argentina, Egypt, Chile, the kind of list goes on. But it's quite diversified. You've got a real mix of countries here. So there's many different ways that you can add value. And then here is the sector mix of the fund. So financials are way ahead at over 30% because banks tend to dominate in emerging and frontier markets because they've often never been taken over by any Western companies because they won't go anywhere near them. Then you've got the raw materials, you've got real estate, industrials, energy, and hardly anything in information technology and nothing in healthcare. Here we have an emerging markets small cap fund. So the liquidity, I think, is quite low, not much volume that's traded. Size of the fund is also fairly small. Chart is not too bad. Number of holdings is huge at over 1,700. Ongoing charges fee, yeah, I mean a lot higher than we're used to for an ETF, at 0.55. Got some performance there, it's not too bad. And then when it comes to the top 10 holdings, it's very diversified. Top 10 countries, and again, we're massively underweight on China. So if you don't like China, then this is possibly something to look at. Interestingly, that tech does come up strongly in a small cap emerging markets fund. So this is something to consider as a means of diversifying away from a global tracker and the S&P 500. But as always, do your own research. I would advocate a Gary Antonacci dual momentum approach. So if developed markets are growing by more than emerging markets, then maybe just hold developed markets. If emerging markets are performing greater than developed markets, then maybe hold some emerging markets, depending on which particular element seems to be performing the best. What are your thoughts on emerging markets? Leave them in the comments below. Don't forget to like, subscribe, and tune in next week for the next video.